Okay, let's get started again. Welcome. Thank you for reminding me to record. But the reason I wanted to pick a company up front is everything we do gets applied on that company. And one of the things you'll notice about the shared spreadsheet I've created for you is if you look at the top line, I've picked my company. You'll see Disney, and you'll see every cell filled in for like 20 cells. Don't freak out. Don't let it intimidate you. Trust me, every one of those cells will get filled out for you. And one of the things I've done with each cell is told you which page in the lecture notes you can look at to see how to fill that cell. So as you get to that cell, and nothing to think about right now other than to pick your company, I'm going to encourage you to enter the numbers for your company into that spreadsheet as we go through. So it's going to operate both as a record of where you are, and also kind of, again, another mechanism to nag you saying, hey, look, you're stuck on company name and it's week 14. Maybe you need to do something a little bit more. So that spreadsheet will become a cumulative record of the entire class, what we're finding. And you'll also see, and this is one of the things that is a little tricky, is you pick a company and you might find somebody else in the class who's picked the same company. Don't freak out. It's okay. It's completely okay. Because one of the things you're going to discover is you and somebody else can look at the same numbers. The numbers are trivial. Anybody can compute the numbers. But how you read them and what you see in them can be different. So if you pick a company and somebody else, and there are some companies that 6 or 7 or 8 people will pick. Now I'll give you and this might be a reflection of what you do in your lives. You pick a lot of Netflix, Krispy Kreme when it was around. People would pick it. And I think what would happen is people would be sitting there, what should I pick? They'll be eating their Krispy Kreme donuts. I'll pick Krispy Kreme. They're watching Netflix. So there'll be companies like Netflix and Krispy Kreme that multiple people pick. It's okay. No, don't worry about it. Just do your company with your numbers and your analysis, and let the other person do that with the same company with the same numbers and come up to a different conclusion. Are there any questions related to the project before we dive into today's topic? No? Okay. Now, the first step in corporate finance is not working through financial statements and coming up with numbers, but assessing where the power lies. Sounds like a strange place to start if you're talking about a corporate finance class. But if you don't know whose interests are being served in a company, it's going to be very difficult for you to explain what's happening in the company. So last session, if you remember, we talked about the tussle between stockholders and managers. Traditional theory, utopian world, stockholders have complete power over managers. And what do managers do? They put they basically look after stockholder interests because they're afraid of stockholders. And then we looked at the 2 mechanisms that stockholders have to exercise control. The first is the annual meeting. And I think we jointly concluded that not much of importance happens at most annual meetings. Okay? Which brought us to the board of directors. And that's where we left off. We talked about how the board of directors in many companies, in most companies, including countries which are viewed as stronger in corporate governance like the US, most companies, the board of directors doesn't do its job. What's its job? To watch managers to make sure stockholder interests are being served. Now, I promised you everything we do in this class will apply on real companies, and I gave you my 6 companies. So I'm going to get started. And I'm going to take you back to 1997 and look at Disney. 1997, does anybody know who the CEO of Disney was?
Michael Eisner.
There's a guy called Michael Eisner, a guy whose ego was so big that he could be in a large room by himself, but it felt crowded. Now, to give you some background on Michael Eisner used to work at Paramount in the mid-'80s. And Disney hired him away from Paramount. And in the mid-'80s, Disney was a company in serious trouble because they were still in the Walt Disney follow through, right? Walt Disney had died almost 20 years prior, but the company was still living in the shadow of Walt Disney. The company was in serious trouble. Its animated movies were going nowhere. Its regular business was falling. Its theme parks weren't doing that well. So they hired Michael Eisner. Eisner came in and he did turn the company around. He brought in new energy, he changed the company. But by 1997, Michael Eisner was not a CEO, he was a Caesar, complete power. He was in complete control of the company. And I'm going to show you the board of directors he put together, because I am convinced that this is the worst board created at a major US company in history. That's quite a contest to win, right? Worse than the Enron board, worse than any of the other boards. And let me back up that claim. First, if you look at the number of people on this board, and you can count the number there, I think there are 17 people on the board. That's already a strike against the board. You know why? Try this out. Get together a group of 17, we break a law already, right? Are you allowed to get together a group of 17? But if you did get together as a group of 17, try to decide where to go for dinner. I'll safely predict what's going to happen. You're not going to have dinner tonight, because by the time everybody tells you where they'd like to, 17 is just way too many people for a group. In fact, studies show that once you get past 9 or 10 members on a board, it becomes dysfunctional. So it's a big board. Strike one. Strike two. In 1997, 8 of the 17 members were Disney insiders, people who either work for Disney or used to work for Disney. Now, remind me again what the board's job is. It's to keep an eye on management to make sure that they're doing a good job, right? But half the board is made up of people who actually are running Disney. Strike two. You see who the chair of the board is? Oh, a guy called Michael Eisner. What a coincidence. Same name as the CEO. Well, not quite. It is Michael Eisner, the CEO, chairing the board. We talked about this last session. Strike three. If this were baseball, you struck out. But this is such a bad board, we'll give them a fourth strike. Let's take a look at the outsiders. Maybe they're so good they make up for all this crap. Let's start at the top. Reveda F. Bowers, head of an elementary school in LA. You're saying this is good. Disney's a kid-oriented company. Have somebody who's around kids all the time. Coincidentally or otherwise, she happened to be the principal of the school that Michael Eisner's kids had gone to. I'm sure it's pure coincidence. Let's keep going down the list. Get George Mitchell, ex-Senate Majority Leader. Now he's probably checking for steroids on the board. That's an inside joke if you followed baseball. But if you keep going down to the next page, it's Father Leo O'Donovan. Any Georgetown grads here? Yeah, I think this is good to have some religious influence on this heathen board. Again, coincidentally or otherwise, Michael Eisner's son went to Georgetown. Michael Eisner served on Georgetown's board, and he'd made substantial contributions to Georgetown University. I'm sure, there's no quid quo pro, but it doesn't pass the smell test, right? Then you keep going. Erwin E. Russell, attorney at law. You see, what do you have against lawyers? I have whole reams of things against lawyers, but this is not the forum to talk about it. But Erwin E. Russell was Michael Eisner's personal attorney. How the heck do you put your personal attorney on the board? Tell me he's going to be an independent third party. It's good to have your lawyer in the room, right? Because he's probably saying, don't answer that question, Mike. Take the fifth on that one, Mike. But don't tell me he's going to be an independent board member. And finally, there's Sidney Poitier, great actor. But guess who's coming to dinner? Guess who's not coming to the meeting? Because Sidney Poitier in 1997 was ranked in the top 10 directors for having missed the most meetings. This is a completely dysfunctional board. And it served its purpose. You know what its purpose was? To be a rubber stamp for whatever Eisner wanted. When Eisner said jump, they asked how high. And it explained some of the really strange things that Disney did in the 1990s. Like what? We go back to the mid-80s when Eisner was hired away from Paramount to come to Disney. He didn't want to leave. He said, look, as a condition for hiring me, I'm going to bring my personal assistant with me. You're saying, what's this big deal about personal assistants? In the days before iPhones, where you kept track of it, your personal assistant kept track of your life. They told you where you lived, who your wife was, when her birthday was. So basically, he said, I can't live without my personal assistant. I'd like him to come with me. You know what the personal assistant's name was? Jeffrey Katzenberg. And he didn't want to leave Paramount. He said, this is such a good company. Why do I want to go to Disney? And to get him to come, Eisner promised him that he could be the head of a division. And to show you how Eisner's mind worked, he said, let me pick the crappiest part of Disney and make him head of that, because what can he do there? And he gave him Disney Animation. Because by the mid-1980s, Disney Animation had crashed and burned. There were no hit movies in like a decade. Everybody was convinced that the days of animation were behind. He says, Katzenberg, you can be head of animation. And to show Katzenberg how little he thought about the business, he said, look, whatever hit movies you make, you can keep 2% of the revenues that we make on this movie in posterity. He was convinced that no movie was ever going to come out of the division. The rest, as they say, is cultural history. Because what did Katzenberg do with the division? I mean, if you're probably too old by this point to remember these movies, but Little Mermaid, Lion King, in a sense, over the next 6 or 7 years, Katzenberg reinvented that division, made it the most profitable division at Disney. Let me ask you a question. If this were a management case, you hired a guy to run a division that you thought was going to go into the ground, and he turned the division around and made it the best and the most profitable division of your company, what should you do to him? You'd move him up the ranks, give him more responsibility, right? That thought never even crossed Eisner's mind. He said, this guy could be a threat to me. So he went to the board and he said, I'd like to fire Jeffrey Katzenberg. And they said, why? He said, I don't like him. Not a great reason to give to fire a division. And they said, what about this 2% of the movie receipts you promised him in the contract? He said, don't pay him. Why? I don't like him. You know what? Katzenberg would have settled for like $100 million in return for the 2%, because by this point, you already had 3-4 major mega hits. Every time, the sea witch opens her mouth, you make $100,000. He'd have settled for $100 million. Disney refused to give him the $100 million. So you know what he did? He sued Disney. And Disney ended up paying $250 million to Jeffrey Katzenberg, which he used as seed money to found his own company. Does anybody remember what company Katzenberg co-founded?
DreamWorks.
DreamWorks. Herein lies the answer to some of those strange phenomena we've never been able to explain. Have you ever watched the Shrek movies? You watch the Shrek movies, right? Notice all the digs at Disney that are embedded in Shrek movies. In the Shrek movies, the Sleeping Beauty had an addiction problem. Snow White, that you could tell all kinds of perversions of that story. There is your answer. That separation between Katzenberg and Disney was so painful that essentially every Shrek movie, you'd get back at them. But it cost Disney $250 million. A few years later, Eisner went to the board and he said, I'd like to hire this guy, Michael Ovitz. He's on the board, actually. Michael Ovitz, at the time he was hired, was the leading agent in Hollywood. This would be like if you're the Yankees, hiring Scott Boras to manage your team. I mean, it's a great agent. He gets the biggest contracts for his players, but Ovitz knew nothing about the entertainment business. But Eisner said, hire him. 2 years later, he went back to the board and said, fire him. He said, why? I don't like the guy. This is becoming a pattern. Disney had to pay $200 million to him as well because he had been fired with no just cause. And every time this happened, the Wall Street Journal would run a story. What's happening at Disney? Why isn't the board of directors doing more to put a check on Eisner? Did anybody at the Wall Street Journal take a look at who was on the board? The answer is right there in front of you, right? You look at this board and say, this is going to be a completely ineffective board. That's why I said, when you look at your company, the first thing I want you to look at is look at the board and then ask yourself, is this the kind of board that will act as a check on management? In fact, to pile on Disney, in 1997, Calpers, which is a California public employee pension fund, one of the largest institutional investors at that time, and was pretty activist also, one of the first large institutional funds to ask questions of management. Why are you guys doing this? You should change the way the company's managed. I actually suggested 3 tests for whether a board is independent. At that time in 1997, you were allowed to have inside directors. The question they asked was, are the majority of directors outsiders? Is the chairman independent of the CEO? And are the compensation on audit committees, the committees that set the compensation for the CEO, composed entirely of outsiders? Pretty straightforward test, right? Not even that high a hill to climb. Disney was the only company in 97 that failed all 3 tests. Now, I told you I was going to pile on. I am going to pile on. So if you go on to the next page, I'm sorry. This was Business Week in 97, ranking companies based on worst boards of directors. This is not a contest you want to win. Look who's on top. Disney. In 1997, Disney was clearly a company with a board that was not operating as a check on management, and it was not alone. So when you look at your company, and for this you have to first pick a company, you want to take a look at who's on the board of directors. In the US, after Sarbanes-Oxley, there have been some changes. You have fewer insiders on the board because it's not as easy to get insiders on the board. You can't get your personal attorney on the board anymore. It's not allowed. And in fact, in the US, you have to file with the SEC if you have any potential conflicts of interest of people on the board. In fact, it's a filing, and I'll send you the link to it, called the 14. It's 14-DEF. So if you go in for every company onto the SEC website, you'll see the filing. And companies will tell you whatever conflicts of interest they have. Now, this kind of information might not be as easily accessible if you picked an Indonesian company or an Indian company, or God help you, a Chinese company. And I know people will come back to me and say, should I switch to a US company? I'll get more information on the board of directors. Sometimes the absence of information is more revealing than any information you can find. And here's what I mean by that. What's a question you're trying to answer when you're looking for information on the board of directors? Is there a conflict of interest? Is this board going to be a check on management? That's a question you're trying to answer, right? And let's say you find a company where you can find absolutely no information on the board of directors. What does it tell you about corporate governance of that company? I mean, it reminds me of one of the Sherlock Holmes books. I don't know which one it is. I don't want to name the wrong one. You know how every Sherlock Holmes book goes, right? There's Sherlock Holmes and there's Watson, and poor Watson is the sidekick. He has the stupid questions, and Sherlock makes him look even stupider. I'm not talking about the BBC series. I'm talking about the original books. And this is one of those stories where, of course, there's a murder, and the key clue that Sherlock breaks in the last chapter is that the dog did not bark. That's it. The clue was the dog did not bark. You say, so what? Well, the dog obviously had a relationship with the murderer, somehow knew the murderer, so the whole case gets cracked open. Remember, when the dog doesn't bark, there's information in its absence of barking. The fact that you cannot get information on who's sitting on the board or what their conflicts of interest are tells you a lot about corporate governance at these companies. And in fact, with companies now, you can look for measures of corporate governance. Because starting about 20 years ago, services started measuring how strong corporate governance. It's checkbox, basically, how many directors are there, how many are insiders, what are the potential conflicts of interest, and they come up with a score for a company. So we go to Yahoo Finance, for instance. I'm not sure whether it still reports it, but Yahoo Finance used to report a corporate governance score for a company and tell you where it ranked relative to the sector. I'll send you a couple of links. You can look up the corporate governance score for your company and get a measure at least of how your company measures up on how good the board is. But ultimately, the test of whether your board is going to do its job is not based on how big the board is and what the corporate governance score is, but what it does. You're looking for tangible evidence that your board has actually stepped in and slowed, maybe not even stopped your CEO, slowed your CEO down when that CEO went out to do something he shouldn't have done. Like what? Like take $1.5 billion of your cash as an automobile company and buy Bitcoin. Are you out of your mind? I don't care what you think about Bitcoin, but you're an automobile company. What the heck? At least we should be glad you didn't buy Doge coin or Dog coin or whatever that other coin is, which is a complete, I mean, I think it's not even a crypto. It's some meme that you're that I wouldn't even say invest, but you're trading in. Well, you know what that tells me about the Tesla board? Why even bother having a board of directors at Tesla? You think Elon goes to the board and says, hey guys, tell me what I should be doing? Does the board even meet? And if it meets, what do? This is the kind of company which shows that you can pass, and that board probably passes every Sarbanes-Oxley rule. You can have independent boards that are completely ineffective. So what if the board of directors doesn't put a check on management and the annual meeting is not that powerful? Well, guess what? As stockholders, you have little power over managers. So guess what they do? Whatever they want. Let's face it, managers have their own interests. This is human nature. We all have self-interest. Managers have their own interests. And often you have to make decisions where you have to decide whose interests are going to be served, your interest or stockholder interest. And when you don't have any checks on you, you're going to put your interests first. So I'm going to list out what managers can do that puts their interests above stockholder interests. And some of these are more egregious than others. So as we go down the list, I'll go from least egregious to most egregious. So most egregious to least egregious. Let's start with green mail. Anybody know what green mail is? It's just like blackmail, but it's just a lot more money and it's legal. So here's how it plays out. Jeremy is going to be the CEO of a company. He's the management of a company. And I'm targeting Jeremy's company in a hostile acquisition. So let me give myself a name. I'm Carl Icahn. You're the CEO of a company. I'm targeting you in a hostile acquisition. What does the word hostile mean to you, Jeremy? What am I planning to do to you right after I take over the company? It's kind of an implicit message.
Get rid of me or sideline.
Get rid of it, right? Okay, so you have two choices. I'm offering 40% more than the current stock price. You can open up your corporate finance book and say, my objective is to maximize stockholder wealth. So I'm going to sell, make sure I get the best price on this deal, even though I could lose the job. That's one option. What's the other one? You can try to fight this hostile acquisition. So you know what you do? You come to me and you say, well, I know you spent $100 million acquiring the 5%. The reason I made this announcement is because once you get to 5% of the shares in the company, the SEC requires that you reveal your intentions. What do you plan to do? Is this just another holding, or are you going to acquire the company? So the minute I got to 5%, I made this announcement, hostile acquisition. It cost me $100 million. You know what you do? You offer me $250 million to go away. That looks a lot like blackmail, right? But this is a legal agreement. So what you do is you make me sign an agreement called a standstill agreement, where I agree not to acquire shares in your company for the next year. Why should you make sure I sign the agreement? Because what could I do if you just paid me $250 million to go away and you didn't have a standstill agreement? What am I going to do? I'm going to take the $250 million. I'm going to start buying shares again, and I'm going to keep doing this over and over again. You paid me $250 million to go away. Let me ask you a question. And Jeremy, I'm going to put you back on the spot. Where did you get the $250 million to pay me off?
I either took it, I took it from the company.
That's the only place you took it. You didn't liquidate your portfolio, sell your house, mortgage your properties. You took my cash to ensure that what happened, that I didn't get paid more than the current market price. And you then tried to tell me that it was all for my good. I've never understood how CEOs get away. I mean, how do you get in front of your stockholders? I did this all for you. I took $250 million of your cash to make sure you can get 40% more than the current stock price. Let's be absolutely clear. There's one interest group that is helped by Greenmail, and it's the current management. There is no stockholder interest here. They did it because they could. Let's keep going. Golden parachutes. Now, one of the things, does anybody know what a golden parachute is?
Essentially, if the company gets taken over, you put in an agreement with the board that if you get fired or if you retire off the board, you get a lump sum of money.
And you do it, and the worst thing is you do it after somebody's made a hostile. It's one thing to negotiate this upfront as part of your contract, right? But Carl Icahn shows up, you run to your lawyer and say, put that clause in, it's a golden parachute. Everybody else gets lead parachutes. To begin with, you don't want either gold or lead to be in your parachute. Neither works that well in a parachute. But with the analogy, the rest of us get lead parachutes, the CEO gets a golden parachute. But again, think about who pays. You're saying the acquirer pays? The acquirer doesn't pay. You know who pays? You and I as shareholders do. Because what the acquirer does is he says, look, I've got to pay out hundreds of millions of dollars in golden parachutes. I'm going to reduce the amount I pay to reflect the payout. Then you have poison pills. You know, one of the things about M&A is it's this strange mix of medieval times and James Bond movies. There are people on white knights with poison pills. I mean, I don't know. Poison pills are basically things you put into your company that you make you unpalatable to a potential acquirer. I'll give you a couple of examples. But until about maybe 20 years ago, the FCC had these very specific rules about how many TV stations you could own in a media market. For instance, so if you were in the LA market, you could only own one TV station. So let's say you're a media company with an LA station, and somebody's trying to do, or I'm sorry, you're a media company without an LA station, and somebody with an LA station is trying to do a hostile acquisition of you. You know what you do? You run out, the minute you hear about the news, you run out and you buy an LA station, you put it in your company, then you run to the FCC and you say, hey guys, you can't allow this takeover to go through, it would be illegal. That's a poison pill. You're essentially putting that in your company saying, if you take this, you'll have something to spit out. I'll give you a slightly more obscure example, but it kind of brings home the power of poison pills. You know what a rights plan is in a company? When you're in a publicly traded company and you have a rights plan, you know how it works? Say each of you is a shareholder in my company, each own 100 shares. And the stock price right now is $10. In a rights plan, I give you the right to buy an additional 100 shares at $5 a share. Now, would you guys exercise that right? You'd be crazy not to. You're saying, why are you doing this? Because I want to raise capital for my company. It's actually the cheapest way to raise fresh equity is to make a rights plan. So in a typical rights plan, I set the stock price, the exercise price well below the stock price because I want everybody to exercise and I want to collect the money. Incidentally, if you don't want to buy additional shares, you can sell your right. Deutsche Bank did this about a couple of years ago. That's a traditional rights plan. Let me rewrite that rights plan. Let's say each of you owns 100 shares in my company. The stock price is $10. I give you the right to buy 100 additional shares at $1,000 per share. You think that's crazy. Why would I want that right? As long as I run the company. But if there's a hostile acquisition or an attempt at a hostile acquisition of the company, guess what happens to the rights plan? The price drops from $1,000 to $1. So as long as I run the company, the rights are useless. But if somebody tries to do a hostile acquisition, all those rights will get exercised, and all of a sudden, you'll have more shares to buy. The objective of a flip over rights plan is very simple: to keep hostile acquirers away. In case you're confused with both those examples, I'll give you a third analogy, and I think this one will bring it home much better. I have 4 kids, are all grown up. But this was a long time ago, and my daughter was about 5 or 6. And I would take her and her 2 older brothers to brunch. We'd go to the diner, we'd sit in a cubicle. I'd sit on one side, all 3 of them would sit on the other. Who wants to sit with dad? That's not kosher. My daughter would sit in the middle. Her 2 older brothers would sit on either side of her. They'd all order eggs with fries. And the waitress would come and put the plates in front of each of them. And the first thing my daughter would do, as soon as that plate was put in front of her, is she would spit all over her fries. Disgusting, right? But if you've grown up with 2 older siblings and you have a plate of fries in front of you, you know exactly what's going to happen to those fries. They're very quickly going to disappear, not into your mouth, but into your sibling. So you know what she was doing, right? She was introducing a poison pill. Why is it a poison pill? Because you spit on your fries, you're completely okay. It's your spit. Nobody else wants to touch those fries. So when you hear the words poison pill in a news story, think about spitting on your fries. That's precisely what the management of the target company is doing, is it's spitting on the fries. The only problem is they didn't pay for the fries. You and I did as shareholders. And now nobody else can touch it. Now, those first 3, green mail, golden parachutes, and poison pills, usually do not require shareholder approval. All you need is a board of directors to sign off. And we've already talked about how ineffective boards are. But there are things you can put into the corporate charter that make it more difficult for acquisitions to go through. One group of changes you can make are called shock repellents. Basically, they're amendments to the corporate charter that make it more difficult for an acquisition to go through. Long time ago, when AT&T was pursuing NCR, this was about 20 years ago, they wanted to buy NCR. Normally, to buy a company, to acquire a company, you need to get to 51% of the outstanding shares, right? Because then you have control of the company. You know what NCR did? It went in and changed that requirement to 80%. You could not change the board. So staggered boards, 80% voting requirements, you can do it in a board. You're saying, why would shareholders vote for something like this? Because they're sheep. Management comes and tells them, we'll use to negotiate the higher price. Guess what? Shareholders fall for it. And then there's this final act, which managers can do. And if your objective as a manager is to make your shareholders poorer in a hurry, this is what you should do. So go out and do an acquisition and pay way too high a premium. I am a cynic. I am extraordinarily negative on M&A. More value is destroyed in the M&A process than any other action companies take in their lifetimes. So let me show you how value changes hands in an M&A. And you can see very quickly why this is the way, you end up with shareholders getting poorer in a hurry. When you go out and acquire a target firm, you have to pay a premium over the current price, right? That's the nature of acquisitions. You can't pay a discount and expect to do it. And what's the story here? There's synergy, there's control. We're going to do great things with this combined company, which might all be true. But here's where reality comes head on against the facts. The very best indicator of whether a merger is going to create value is what happens on the announcement day to the stock price of the acquiring firm. not the target firm. We know exactly what will happen to the target firm stock price on the day the announcement is made, right? The target firm stock price jumps through, and that's the company we tend to, but look at the acquiring firm. You know that half of all acquisitions, close to 55%, the acquiring company's stock price drops when they announce an acquisition. It drops. It might be 2 or 3%. You think that's not very much, but if you're a $100 billion company, $3 billion. You know what the market's saying, right? Nice story, but we think you overpay. Now, if you ask, if you ask M&A bankers, their response is, but the market doesn't know as much as we do. Let's evaluate that claim first. Is that true? Absolutely. You are insiders. You could see things in the target company that outsiders might not. So it's true. The managers and the bankers involved in the deal do know a lot more than the rest of us who are making judgment on the deal. But here's something to think about. If you track M&A deals through for 5 or 10 years after the deal, that synergy we talk about, completely elusive. It's easy to show it in a spreadsheet when you do the acquisition, much more difficult to deliver in dollar value. It doesn't seem to show up. You know that half of all acquisitions are reversed within 10 years of the deal. The acquirer says, it didn't work, sorry. So I'll use one example of how acquisitions destroy value. You guys familiar with Eastman Kodak? When you think of it now, you think of it a deadweight company somewhere in Rochester that produces things. I don't even know what they make anymore. But there was a point in time where they were the camera company of the world. In fact, in the early 70s, they were one of the nifty 50, one of the 50 fastest growing companies in the world. And Eastman Kodak was a well-regarded company, a company that was viewed as having good management, makes good decisions, and was priced as such. Until 1987. You think, what happened in 1987? In 1987, Eastman Kodak got into a bidding war for a pharmaceutical company called Sterling Drugs. It got into a bidding war with Hoffmann La Roche, which is a European pharmaceutical company, for a drug company called Sterling Drugs. Now remember, Eastman Kodak, camera company, it's targeting a pharmaceutical company. And they talked about synergy. I couldn't even visualize what the synergy would be. Maybe they found a way to deliver drugs through the camera lens. I don't know what it was, but they claimed that there was synergy. But they got into a bidding war. Now, to give you a sense of how much this bidding war pushed up the price, Sterling Drugs was trading at about $40 per share before the bidding war started. And the bidding war kept pushing the price up. At $72 per share, Hoffmann La Roche dropped out of the bidding war. And Eastman Kodak didn't seem to notice. They kept bidding up. It's like being on eBay. The other person's dropped out, but you keep bidding up. I beat my own price. It's very easy to beat your own price. And at about $90 per share, Eastman Kodak won, if you can call it winning. Have you heard of the winner's curse in an auction? You know how it works, right? You go to an auction, you see something that you absolutely want, and you start bidding and bidding and bidding, and you win the bidding war. You get up to celebrate, and everybody else around you starts to clap as well. You should be careful, because why did you win? Because everybody else in that room thought you were paying too much. Remember that in a bidding war. When you win an auction, everybody else in the room thinks you're paying too much. Maybe you know something that they don't, but that's the truth. In M&A, when you get into a bidding war and you win, you should always have mixed feelings about winning. And the market did. In fact, on the exact same day, where the Wall Street Journal had a headline saying Eastman Kodak wins bidding war, take a look to the right at what happened to Eastman Kodak's stock price. It dropped by roughly $5.2 billion in one day. They wiped out 20 years of careful capital budgeting with one big deal. This might be pure coincidence, but the premium they paid for Sterling Drugs over and above the original market price was about $5.1 billion. You see why this is almost a zero-sum game? If you overpay, somebody's got to feel the pain, right? And in this case, what's the market saying? We see no synergy. Everything you paid is for nothing. So we're going to take it out of your value. But Eastman Kodak said, trust us. We have great management. We have supremely well-trained bankers. We've seen the spreadsheets. There is going to be synergy. Huh? If you track what happened at Sterling Drugs in the following 5 years, where's the synergy? The earnings stagnated. And these were 5 years where traditional pharmaceutical companies were continuing to grow. There seemed to be no growth synergies, no profit synergies. And 5 years later, rumors started to float around that Eastman Kodak was planning to sell off its drug unit, that things weren't working out. When this rumor first showed up in the New York Times, the chairman of Sterling Winthrop, which was the division, said this was a complete lie. It's like the old Soviet Union, right? Never believe anything until it's been officially denied. Well, it's been officially denied. Well, a few weeks later, Eastman Kodak sold off Sterling Drugs for $1.7 billion. Remind me again how much they paid I mean, if you think about this, this clearly was a deal that did not make financial sense. But the damage was done. To me, that acquisition of Sterling Drugs transformed Eastman Kodak from a company that was well regarded to a company where nobody trusted them. I know your digital cameras and smartphones and all the rest of the stuff was still coming, but Eastman Kodak had damaged itself so badly that there was no way for it to come back. When you see a company talk about a big acquisition, the CEO will paint it in the best possible terms. This is good for the company, amazing, and the synergy word will come out and bankers will provide the numbers. But history works against companies that do big acquisitions. And with Disney, I'm going to show you some of the things they did, especially in the 90s, that came back to haunt them. But this is value transfer. So when you look at your company, the first place I want you to look at is, where does the power lie in my company? And let me give you some choices. It could be that very rare company where shareholders are the ones driving the company. Decisions are made in shareholder interest. It is going to be the exception. It could be a company where shareholders have absolutely no power, managers essentially rule the roost. Their choices drive what the company does. It might be a company where it's not all shareholders, but a subset of shareholders. I'll call them inside shareholders run the company. I don't want to be mysterious, but any of you shareholders in Facebook? I am, but I operate under no delusions here. I have no power at Facebook, but there is a shareholder at Facebook who has a lot of power, who's Mark Zuckerberg, inside shareholders. There are some companies where lenders effectively run the company. You know when this happens? Is when you end up with covenants that you violate. The bank steps in and says, hey, you guys can't run the company anymore. We'll make the decisions. It could even be a company where the government essentially is the power behind the throne. Why? Partly because this company used to be a government-owned company. The government has privatized the company, but it still has all of the levers of control. This is going to be a judgment that's not going to be easy to make. I can't say, look at this number, it's going to give you the answer, but it is a judgment you have to make. In your company, where does the power lie? And I'll give you one thing that might help you make this judgment. Now, I know it's tough to get to a Bloomberg, but there are a couple of Bloomberg terminals that are accessible still at Stern. And I'm going to send you, the pages you need. So if you can get to a Bloomberg, great. If not, I'll give you public sources you can use. One of the things I would recommend you find out about your company is, who are the biggest shareholders in your company? In fact, in Bloomberg, this is a page called the HDS page. You pick any publicly traded company anywhere in the world. It's amazing. And you type in HDS, it'll list out the top 17 shareholders in your company. You're saying, what is that going to tell me? Let me take you back to 2003. And I typed this for Disney. This is the page that popped up. When you look at that page, take a look at the names, right? You got Barclays, Fidelity, Citigroup, State Street. In fact, the clue here is if you look at the third column, you see a source. It says 13F. You're saying, what the heck is that? That's a filing made by a mutual fund with the SEC when it owns shares in a company. 16 of the top 17 shareholders in Disney are institutional shareholders, mutual funds and pension funds. If I were a shareholder in Disney and I saw this page, my stomach would drop right there. You know why? What did we say about institutional shareholders? If they don't like the way a company's run, they're not going to stand and fight. In fact, the only individual in that group was Roy Disney. But he was on the board already in 2003. I'll give you a little bit of the rest of history for Roy Disney. But in 2003, he actually worked at Disney as the head of he was the head of a division. And the shares he owned were 0.67% of the outstanding shares. So if you ask me in 2003, where does the power lie at Disney? My answer would be an unalloyed. It lies with the management of the company. I don't see this company as being the kind of company where somebody's going to push the company to change the way it's run. Let's move to Vale. Vale was the Brazilian mining company, right? And already I know I'm in trouble because in Brazil, almost every large company has two classes of shares. One class of shares is called common shares. The other class is called preferred shares. And preferred shares in Brazil are not like preferred shares in the US. Preferred shares in the US are more like bonds. You get a fixed dividend. But preferred shares in Brazil are really non-voting common stock. So every Brazilian company has common shares, voting shares, and non-voting shares. Now, I'll be cynical here. You pick up you go into your online brokerage service and you buy shares in Vale. Which shares do you think you're going to be getting, the voting shares and the non-voting shares? Almost every share that's traded out there is a non-voting share. Saying who owns the voting shares? It's a group of 7 entities, and one of them happens to be BNDES, which is the Brazilian National Pension Service, run, of course, by the Brazilian government and people up in Brasilia. Already I'm throwing a clue here. And it's the voting shareholders who will decide who sits on the board and what happens at. And so basically, they're the power that'll drive the company. But to show you how even this amount of control is not enough for governments, the game is even more tilted in favor of the government. Vale also has what's called a golden share. You know what a golden share is? This is a share that if you own, you get veto power over big decisions. The UK government actually invented the 1980s when it first started to privatize companies. It said, look, we're going to keep the share in case you decide to do something big, we're going to step in and veto it. And the government of Brazil owns the golden share. So when you look at the board of directors for Vale, you know what you're going to see? A heck of a lot of government influence. You're saying, so what? Well, it's not that governments are venal, but that they have their own interests at heart. Let me give you an example where this will play out. If you're a publicly traded company and you decide how much to pay in taxes, I don't want to sound unpatriotic, but your objective is not maximize taxes paid to the government, but to minimize taxes subject to whatever the tax laws are, right? So let's say the Vale board has the CFO comes in and says, we have this plan to kind of reduce the taxes we paid this year by doing this. You know who's going to object to that? The 3 directors in the government are going to put up and say, I don't think that's a good idea. And you can see why, right? Where do the taxes that you pay go? They go to the government. So whenever there's a decision that puts your interests against the government's interests are going to win out. I'll send you a link to how this can play out in an endgame. And I wrote this almost 6 years ago at the height of the Petrobras crisis, because Petrobras looks just like Vale. It used to be a government-owned company that became public. The government continued to run the company. The CEO was appointed by the Ministry of Finance, and decisions came from above. You're saying, so what? Well, the Brazilian government, about 15 or 20 years ago, went to Petrobras, and from the top down, they told the CEO, your objective should be to become the biggest oil company in the world. Why? Because we give Brazil bragging rights. So we want to have the biggest oil company. And the CEO took it to heart. So you know what Petrobras did? It went looking for oil and more oil and still more. Even though it would have made no sense to develop those reserves, it kept looking for oil because it wanted to become the biggest oil company. And in the process, it almost destroyed itself as a company. In fact, if I were using an example of a company where everything is done wrong, remember in every decision we talked about the investment principle, financing, and the dividend principle, if you looked in a perverse world where you said, my objective is to minimize my value as a company, how would I run a company? That Petrobras could show you how to do it. Let's move to Tata Motors. In 2013, if you look at the top shareholders in Tata Motors, notice what you see on that list. There are a lot of Tata companies on that list. And this is not a conspiracy to make your life difficult. It reflects the history of Tata Motors as a company. Until about 40 years ago, the Tata Group had no publicly traded companies. Almost every company was privately held. And here's how it worked. If Tata Steel wanted to build a factory and it did not have enough capital, the family would go to Tata Motors, which had a good year, take money. After all, they owned 100% of both companies. They would take money out of Tata Motors, put it into Tata Steel, and the accounting would be that Tata Motors gets shares in Tata Steel. Do you see where this is going, right? The companies go public. You're going to see 6 or 7 other Tata companies listed as shareholders, the company and lead shareholders. Now think about this from the consequence of what does it mean for you as a shareholder in Tata Motors? Tata Motors has to make a big decision. It's a decision that could affect its other Tata Group companies as well. I think there's going to be an incredible amount of pressure on Tata Motors to do what's right for the group rather than what's right for the company. Even though it's a separate, publicly traded company, there will be times where it does things that make no sense for it as a company, but make sense for the group. You're going to see this play out as you look at how Tata Motors decides how much to borrow, which projects to take, how much to pay in dividends. Again, I'm not pointing fingers. I'm just saying you have to have that reality check of where the power lies, rather than get frustrated and say, why is the company doing what it is? And I remember when I did this in 2013, I actually presented in India in 2014. And the pushback I got was, but the Tata Group is such a benevolent group. And among family groups in India, it has a reputation of being more caring about its, about how people perceive it, more caring about its shareholders. But for those of you who've tracked the Tata Group and you look at what's happened since, you've seen this corporate governance problem kind of bubble up to the surface. And Tata Motors and the Tata Group has had to go through this issue of where does the power lie? Because the family, in a sense, has come back and said, hey, we have the power. We're going to drive decisions that make sense for us. So just because a group is benevolent doesn't necessarily mean that you're going to be okay giving them the power to drive decisions in publicly traded companies, because things can change. And finally, let me look at Baidu. Baidu, as I said, is a Chinese search engine. It gets almost all of its revenues in China, but it's listed and traded on the NASDAQ. And as I said, they do it because they want to get around this Chinese government restriction on technology companies going out and raising capital from foreigners. But to get around it, here's what they had to do. They had to create a shell company in the Cayman Islands called Baidu. The shell company is an agreement with Baidu, the Chinese operating company, and in theory at least, the agreement entitles them to all of the revenues and profits of the operating company. And when you buy shares in Baidu, you're not buying shares in Baidu, the Chinese company, you're buying shares in Baidu, the Cayman Islands shell. You see how dangerously exposed you are as a shareholder? I mean, that operating agreement that Baidu, the Cayman Islands entity, has with the Chinese company could in theory be, a Chinese court could say that agreement is completely null and void. In which case, what are you a shareholder of? A small property in the Cayman Islands with a sign outside that says Baidu. Try liquidating that, see what you get for that. And think about it. Alibaba is exactly the same structure. Alibaba, the publicly traded company, is a NASDAQ company, but that company is a shell company. So if you buy shares in Baidu or Alibaba, I'm not saying you shouldn't, but if you do, again, walk in with open eyes, right? You're not going to get any say in how the company is run. With Alibaba, I used to think that Jack Ma had complete power. We're discovering that power could rise. There might be people, in a sense, above him in this, but those people are not you and I as shareholders. So again, I'm not trying to warn you away from companies. I'm just saying we need to be realistic. A couple of other examples, and I'll leave this topic alone. Let's suppose you pull up the top 17 stockholders in your company, and you find Carl Icahn is one of those 17. Now, you don't have to like Carl Icahn, but as a shareholder in a company, do you feel a little more comfortable about your position knowing that there's a Carl Icahn or a Bill Ackman on there? I do. Not because they know what they're talking about. Carl Icahn says some, I mean, let's face it, Carl Icahn is not the deepest thinker in the face of the earth. Here's what he does. He goes to a company and he says, you have too much cash, give me the cash. That's pretty much every Icahn pitch, right? But it's good to have that pushback because it forces managers to explain what they do. I know activist investors are viewed as terrible people. And let's face it, I won't have dinner with Carl Icahn. I'm afraid he'd eat me. But we need activist investors in markets. In fact, I'm going to give you an analogy that you might find distasteful, but I'm going to give it anyway. Activist investors operate as market laxatives. You heard that right, market laxatives. Nobody wants to take a laxative. It makes the next day unpleasant. But without activist investors, you know what happens in markets? They become constipated. There's no change. You have zombie companies wandering around because they're not afraid of being challenged. So much as you might dislike what an Ackman or an Icahn does, you need them to keep managers in line because the threat of them being there is often sufficient to make companies behave differently. So look for an activist investor. The only problem is you will never see the name Carl Icahn or Bill Ackman directly on a list because they have companies as fronts. And I'll give you the list of activist investors and what you will see as the front, right? Whether it's Elliott or whether it's Ackman or any of the other groups. I'll give you the name of the group you will see on your list because if you see that on your list, it increases your chances of at least getting some pushback. One final example, and then we'll kind of leave this alone. So let's say we did, you know, anybody picking Google or Facebook as their company for it? No, nobody? Let's say we took Google, right? And you go to Bloomberg and you type in HTS. The first thing you're going to notice is that there's not one Google, there's multiple classes of shares. I'll give you my cynical view. Whenever you see multiple classes of shares, already you've lost the game. Because when you have multiple classes of shares, here's what you will get. One class of shares has far more voting rights than the other. And the cynical part should kick in and say, look, if that's the case, we know who's holding those shares with the higher voting rights. In the case of Facebook, it's Zuckerberg. In the case of Google, it's Brin and Page. Basically, you know that somebody's holding the power. I still remember when Facebook went public and they created this, two classes of shares and 10 times more voting rights for the first class, and Zuckerberg owned those rights. He had 57%. And I asked portfolio manager, are you at all concerned about the fact that you've conceded the power essentially in perpetuity? Because remember, this is not a one-time deal. You concede in perpetuity to those insiders, the founders. And the response I got was, but it doesn't matter at Facebook because Zuckerberg is a good guy. And I know the analogy doesn't quite follow through, but if you're asked, would you rather live in a democracy or a dictatorship? You know how some people who are not comfortable with either split the difference? They say, I'd like to live in a benevolent dictatorship. I'd like to live in Singapore. Those guys look hard for me. The only problem is, you know what happens to benevolent dictatorships over time? They turn malevolent. And the question is, what are you going to do then? So the problem, and this is something we face increasingly now in the US as companies go public. Airbnb, for instance, came in with 4 classes of shares. Why settle for 2? The Class A shares have 10 times the voting rights of Class B. They're owned by the founder. Class B shares are the shares that were in the public offering. The Class C shares, this is add insult to injury, haven't been issued yet, but they're going to have no voting rights. This is when they want to rub your face in the dirt saying, you think you have no power? Let me show you what no power really looks like. And then they have a Class 8 shares, which, at least the way they've described it, is going to make them a good company. They're going to raise the money from the Class 8 shares and use it to make their hosts better off. And I mean, but it's all at the moment. It's like their lip service to ESG, something we're going to come back and talk about. 4 classes of shares. So that's the first step. Look at who the top shareholders in your company are. But remember, things can change. In 2009, I revisited Disney's top shareholders. Take a look at this list now. Look at who's on top. How did Steve Jobs become the largest shareholder in Disney? I thought Steve Jobs was CEO of Apple. How the heck did he become the largest shareholder in Disney? Anybody have an answer to that?
Well, it was the
Disney
Pixar
acquired Pixar.
Because Steve Jobs owned 60% of Pixar, and Disney, when they acquired Pixar, paid in shares. And the minute the Pixar acquisition went through, Steve Jobs became the largest shareholder in Disney. Now, let's say you're a Disney shareholder in 2009. You look at this list. Remember in 2003, your stomach dropped. What do you think about Steve Jobs being the largest shareholder? Is this something that makes you a little more comfortable with this corporate governance, a little less? And obviously, you don't know Steve. I don't think any of you know Steve personally, but he's not thinking about your interest. But what is this stock ownership going to do that the previous one did not? You guys have read about and watched Steve Jobs movies, right? And when you think about Steve Jobs, you don't think of a get along and go along kind of guy. That's not Steve Jobs. Steve Jobs served on the board of directors. I don't see Steve Jobs being a wallflower at board meetings saying, oh, if you guys release Snow White every December. Remember, Disney released Snow White in movie theaters every December for like 60, 70 years, because that's what they've always done. Can you imagine Steve Jobs saying, if that's what you guys always do, that's what you should keep doing? I mean, I can see him at meetings shaking things up and this is stupid. We shouldn't be doing it this way. You see what you want in the board of directors is somebody to push back. And there's no guarantee that Steve Jobs will push back, but at least now you have a chance. That's all you can ask for as a shareholder. You and I don't have the power to push back against the management. You want somebody there to do it. So that's the first stop. Stockholders and managers, think about where the power lies in your company. Let's move to the second link. In the utopian world, if you remember, people lent money to the firm, bondholders and banks. They didn't protect themselves, and nobody got ripped off because people worried about reputation. They took care of, they took care of the bondholders and lenders' interests. In the real world, you lend money to somebody and you don't protect yourself. It's not a question of whether you get ripped off. It's a question of when. And let me explain where this view comes from. As stockholders in a company, what kind of claim do you have in the company? A residual claim. You get whatever's left over. As a lender to a company, what kind of claim do you have? A contractual claim. You have to be made interest expense. So think about it. Kushal, you're going to be the banker. I'm going to be the shareholder. We're looking at the same company. Let's go through decision by decision on what you would want the company to do versus I. So first choice, my company's accumulated a lot of cash. It has no use for the cash anymore. The company's mature. There's nothing to invest in. As a stockholder, I want the cash returned to me because after all, if you have no use, might as well pay it to me. So I want dividends. Kushal, what would you like the company to do, given that you're a lender to the company?
Pay off debt.
Pay off debt or keep the cash and pay my interest, right? In other words, you want the cash held for you because it makes the company safer. Already we have a conflict of interest. Lenders want less dividends, less cash return. Equity investors will want more dividends, more cash return. Second, as a company, I find a new business I want to enter into, but it's much riskier than my existing business. As a stockholder, I think there are opportunities. I want to invest in the business. As a lender, what do you tell me? When you say, no, don't do that. I don't care if artificial intelligence is the place to be. I don't want the money to be, already you can see conflict of interest and where to invest. And here's the third question. Let's suppose I'm thinking about raising more capital. I can either borrow the money or issue more equity. As an equity investor, I really don't want to issue more equity. It'll dilute my holdings. I want to go borrow the money. I come and ask you, is it okay if I borrow more money? What's your first response going to be? Please don't. And especially not using the same assets used to secure my lending. On almost every decision, what's good for equity investors and what's good for lenders can be in conflict. It's a fact of life. So what do you have to do as a lender, Kushal? When you lend money to me, what are you going to do? You're going to put restrictions on dividends. You're going to probably require veto power over many acquisitions, especially if it's a risky acquisition. And if I choose to borrow money, you might decide to revisit your agreement to raise the interest rate or tighten your covenants. So you protect yourself to make sure that you don't get ripped off. You say, but what if the company I'm lending to is a company with a long history and a great reputation? Be especially careful then, because then you might be tempted to say, look, it's a great company, it's not going to rip me off. You loosen the constraints, you're going to be taken advantage. And I'll tell you a story to bring home this fact. Early 1980s, you retired. I know it's putting you back in time in a different body, but you've retired. You moved to Florida. Why? There are no estate taxes. You live in a golf course. Why? Because you like golf. And I'm your broker. Well, these were the days you actually didn't have a physical broker. You come to me and say, look, I have $1 million in savings. I'd like to invest it in something safe. I'm a retired person. I need the money. I suggest some stocks in a mutual fund. He said, no, too risky. Stocks can go down. I suggest some T-bonds, and initially you're interested, but then I tell you what rate you will make. That's too low. It won't cover my golfing costs. And I suggest a nice corporate bond. Initially, you're a little worried because companies can default. And I say, don't worry, this company's been around a long time. In fact, when I tell you the name of the company, you'll probably recognize it. It's RJR Nabisco. And they say, yeah, I've seen their name all over the grocery store. They've been around a long time, right? And I say, yes, not only have they been around a long time, they're rated AA. You have no idea what this even means. So I tell you that no AA rated company has ever defaulted while it was rated AA. I'm a very careful broker. That's technically true that no AA rated company has defaulted while it was rated AA. So you take your $1 million, you buy these AA rated bonds, and you go back to playing golf. A couple of years later, you open up the Wall Street Journal, and there's a news story. It says, KKR does LBO of RJR. You have no idea what these acronyms even stand for, but the only word you recognize is RJR. Oh my God, that's the company I have my bonds in. So you call me and say, what happened? Well, technically nothing has happened. There's this outfit from New York called KKR. It's come in and they bought out Nabisco, borrowing 4 times more money than the company used to have. You say, what does it mean? Well, you still own the same bonds you did yesterday, but remember I told you they were AA rated? They're still in the alphabet, but they've slid. They're now BB rated. Why? Because you might be promised the same payment, but now there's a much bigger chance you will not be paid. On the day of RJR Nabisco's LBO, the day that the equity investors were celebrating, take a look at what happened to RJR Nabisco bonds. They dropped by about 20%. Remember the $1 million you had? It's now become $800,000. But why were RJR Nabisco bonds affected? Because they did not protect themselves against a leveraged transaction. Essentially, the company changed the rules on them, but they had no protection built in. And in '87, no corporate bonds did, because the assumption was if you're issuing corporate bonds, you must be a mature company that cares about your reputation. We don't need any protection. We've learned since, but in '87, that was the learning curve. So if you think you can lend money to a company and not protect yourself, think again, because no matter what the company's name is and how well regarded it is, if you don't protect yourself, you're in a sense asking to be taken to the cleaners. So the second link also gets shaky, right? So what I'm doing is taking the utopian world and taking the links, and each link I'm shaking. Let's take the third link. What do we assume? That companies reveal information about themselves honestly and on time to markets, and markets are rational and cool. Remember, the trading room that I described in the utopian world is full of polite intellectuals. So in theory, if that's the case, here's what's going to happen. Markets are going to reward you when you do the right thing, take good projects, find yourself with the right amount of debt, pay the right amount of dividends. They're going to punish you if you do things that hurt you in the short term or the long term, because value reflects everything. But in the real world, there's lots of holes in both sides of the assumption about A, the release of information markets, and B, how markets respond. Let's take the point about managers revealing information about themselves honestly and on time. It's true, some companies commit outright fraud, but let's put that to the side. What's more common? So let's take that extreme scenario. Are there some companies that commit outright fraud? Yes. I think they're more the exceptions than the rule, but they do. I still remember a company called Briax. It used to be a Canadian gold mining company, one of the most highly touted gold mining stocks on Wall Street in the 1990s. And it claimed to have found the biggest gold reserve in the world somewhere in Indonesia. And actually flew equity research analysts up. Let's face it, most equity research analysts who track gold mining companies have never seen a gold mine. So they put them on a plane, they flew them to Indonesia. They landed near where they claimed they found it. They took them out and they said, look, there's so much gold under the ground, it's coming out. They'd actually salted the soil with gold dust. And they said, look, there's so much gold, it's coming out. And these analysts all flew back and said, buy the company. They have so much gold, it's coming out of the ground. And then little pieces of news come out about the company. The first thing that happens, the geologist who worked for the company, who claimed to have found the gold reserve, jumped out of a plane at 35,000 feet without a parachute. Nothing good can happen to you if you do that. And then people started asking, why did he do it? Was he depressed? And it turned out that the gold reserve that supposedly had hundreds of millions of ounces, the company little by little said, no, we said there were 400 million, but there are really only 40. Then it became 4. And finally, it turned out that the whole thing had been a concoction. That is outright fraud. Oh, here's another example of outright fraud. Things or outright misuse of information. I remember the late 90s reading a Wall Street Journal article about a company called Mercury Finance, company that lent to subprime, people who had bad credit. Not a pretty reasonable business. This is what the article said. Mercury Finance announces it cannot find its CFO. Seriously, that's what the news story says. Can't find our CFO. We've looked for him everywhere, under the table, in his house, in his apartment. And half the cash balance of the company is missing too. Somebody's having a lot of fun somewhere, but it's not you and I as shareholders. That is outright fraud. But here's what's more common. Managers try to control the flow of information markets, and it's human nature, right? How many of you are married? Anybody married? Michael, you're married? Okay. Let's suppose you have some bad news. I'm not putting bad news in your life, but let's say it's the old days. We actually had to go out. You got some bad news. You come back home at 6 o'clock. You open the door. Here's the one thing you don't do. You say, "Hon, I have some really bad news. I needed to share with you right away." That's not what you do. You try one of two strategies. One is you look for a good time. Not now, not now. Window of opportunity open, closed again. Maybe when she's sleeping, I will whisper the news to her. I told you last night. You look for a good time. The other is you try to bundle the bad news with some good news. This morning, while I was driving the car, I hit a tree. In fact, I wrapped the car around the tree. But good news, I switched to Geico. Completely disproportionate, but you try to bundle good news with bad news. Do you think companies do the same thing? Do they try to find a good time to reveal bad news? What's a good time? When is the market sleeping? Increasingly fewer and fewer times. But if you look at companies and you look at earnings reports by day of the week, and this is from an old study I did, when I actually did research, where I broke down earnings and dividend announcements by day of the week and looked at what news they contained. Mondays, Tuesdays, Wednesdays, Thursdays all look pretty much the same, right? But Fridays were terrible days. So I took a closer look at Fridays to see when these announcements came out. You know when they came out? 4:01 p.m., 4:02 p.m., 4:03 p.m. New York time. Companies reveal, for instance, JP Morgan. Remember the whale incident where they lost like $7 billion in London? You know when they announced it? 4:15 on a Friday. They hope that you forget it by the time you get around on Monday. It never happens. We remember it still. But companies try to kind of decide when to release news. And they try to bundle the bad news with the good news, right? I remember in 2009, here's how banks would report their earnings. We lost $3 billion. Incidentally, that's a bad news, but we're not Lehman. That's a good news. It could be worse. Companies and managers try to control the flow of information markets, and markets don't always respond rationally. Next session, when we start off, I'm going to start with that question, because right now, especially coming off the GameStop episode, there are a lot of people who are willing to give up on markets. Markets are crazy. Why we even focus on market prices? And it's, well, I can see where that feeling's coming from. But the question I'm going to pose is, if you don't trust markets, who are you going to trust instead? Is it going to be managers? Is it going to be, you can't just say, I don't trust markets and replace with nothing. The question is, what is it you're going to replace with? We'll start with that on Wednesday and talk about, hey, where are we going to put our trust if we don't trust markets? I will see you on Wednesday.
Thank you, Professor.
You're welcome.
Thank you.
Take care.
Thank you. Have a good one.
Thank you.
Thank you at the
Bye-bye.
UCLA, Hari.
I am a UCLA grad, long time ago.